to the present. It is Sunday, starting your last week of the class, and obviously we need to spend a little bit of time talking about the coronavirus effects on the economy, and that's what I'm going to do here in 2 or 3 videos. I'm not really going to talk about the coronavirus itself. I'm not really authorized to talk about that. That's not my skill set, and I suspect you're learning a lot about that on your own. But instead, I want to think about the economy and the economic response that we've had from both the federal government and the Federal Reserve. This is a really interesting time to be studying economics, and I don't want to waste this opportunity to teach you guys about what's happening right now in the world. So, let's think about how the coronavirus is affecting our economy. And we've talked about this a little bit already, but you can kind of think about it from 2 sides. There are supply side effects and there are demand effects. So first, let's think about the supply side. This is the production side of the economy. Obviously, you've got a significant reduction in U.S. employment. This is a result of mandated stay-at-home orders. This is a result of businesses, in some cases, voluntarily deciding to shut down even though they don't have to. And this is an unprecedented increase in unemployment. It's nothing we've ever seen before in the United States. So actually, we've had 22 million new unemployment claims in the last 30 days. That is a record by far. So we have this huge burst in unemployment. The unemployment rate is going to be the highest that we've seen since the Great Depression when those rates get released. There's always a lag with those. It takes a little while to get those posted. But of course, it's not quite as bad as it might seem. I'd rather have 20% unemployment because of this than 20% unemployment just in sort of a typical economic period. We can rebound from this most likely if we're able to get people back and working. Okay. By the way, there's definitely been some people out there saying that we're harming the economy too much by shutting down. Most economists think that it was a good idea to shut down a lot of these non-essential businesses. The argument often is, well, let's just keep the economy running. But a lot of people would still choose not to work. A lot of people would still choose not to shop. So if you don't shut down these businesses, there's still going to be a significant economic slowdown. And the goal here is we're kind of ripping the Band-Aid off. Basically stop a lot of economic progress and then jump right back in and get it back going in the future. That concerns me in terms of how long it'll take for us to get back to full production. Could take a couple of years for that to happen, depending on if we can get a vaccine or whatever. But in terms of the economic response, most economists think it was a good idea to go ahead and shut down a lot of these businesses. That's not the only effect on the supply side. There's also these massive supply chain disruptions. This is actually the first effect that I believe we talked about this in class. This is one of the first effects we saw from the coronavirus, was that, when it first started hitting China, it was harder for U.S. businesses to buy the goods that they needed, the raw materials that they needed from China to produce goods and services. That supply chain disruption is continuing. It's hard to get things imported from other countries. If we need something in Georgia from let's say South Carolina, even that might be tougher than it normally would be. So you've got it harder for businesses to produce what they need to produce. So if you're a business that's in construction, you may be trying to stay open, but if you can't get the raw materials you need, it maybe doesn't matter if you're trying to stay open or not, right? You're not going to be able to. So this is a big deal as well. And then of course, the effect is felt on both sides. So if we're thinking about, should we think about this from a classical or Keynesian standpoint, both are practical, right? Keynes believes that demand drives the economy. Classical economists believe that supply drives the economy. And on both sides of the economy, we've got these significant disruptions. So on the demand side, obviously we've got wages going down, right? And as a result, aggregate demand is going to drop. People's wages are going down because they're not working as much. Some people are getting pay cuts. So for various reasons, wages are going down, and so that's going to adversely affect aggregate demand. Likewise, investment returns are going down. If you have money in the stock market, you've seen a big drop there. I don't know if you followed it much, but there actually has been a really nice recovery in the stock market. A lot of that's in response to these dramatic efforts being made by the federal government, the Federal Reserve, to try to stimulate the economy. But nonetheless, there's still been about a 20% drop in the value of the entire U.S. stock market. So if you've got money in these investments, you've lost money, right? You've lost perceived value. And so as a result, you spend less. So you're thinking about buying a new house. Well, if you just lost 30 grand in the stock market, maybe you decide it's not a good time to buy. Simultaneously, you may have also seen a drop in your wages, and so these things kind of work in tandem to cause people to reduce their spending. And then lastly here, we've got uncertainty, and that also reduces aggregate demand. Typically, when the economy is more uncertain, people will choose to spend less and save more, and that tends to slow down the economy. I think I mentioned this in class. I was thinking about buying a house right when all this stuff started going down, and now things are just too uncertain to me. What if I get a big pay cut? What if I have continued reduction in my investment value? So I won't buy a house. I wouldn't consider buying a new car right now either. So because of this uncertainty, it's not just because things are bad, but because things could stay bad for a long time. That uncertainty is going to cause people to reduce their spending. So on both sides of the market, you've got reduction in production, you've got a reduction in consumption, and so the effects here are going to be pretty big. And so maybe the biggest economic concern here is what's going to happen in financial markets. Okay, and I kind of dropped that out as separately because the financial market, it's kind of like the enabler, right? Think about what the financial market does, banks and such. They help stimulate new business growth. If I want to start a new business, I'm probably going to borrow money, possibly from a bank, and so that financial market is needed to create increased production, right? At the same time, if I'm thinking about buying a house, well, I'm going to have to get a mortgage. And so the financial markets are going to feed into that demand side. And so from an economic standpoint, a lot of concern is always placed on these financial markets. One, because they're so important, right? They're so important in terms of determining both the supply and demand side of the economies. But also, two, it's maybe the part of the market we have the most control of. The Federal Reserve oversees the financial system. So this is an avenue to try to improve some of these issues that we have, okay? And just to see why the financial markets are always such a concern, let's just think about what's happening right now and see if we can kind of think through some potential outcomes here. So I want to address this question here. What if people stop paying their rent? Or mortgages, right? Similar effects. What if people stop paying the rent? Or perhaps, what if people stop paying their mortgages? Let's think about what would happen. This has been a big topic, right? And a lot of y'all pay rent at Georgia College, so this is something you might think about as well. I think the dorms, they stopped charging people, and that's, I guess, good for you guys. But obviously there's consequences beyond that. If people aren't paying their dorm rent, well, then the college is reducing its revenues, and they've got to figure out a way to stay sustainable in that environment. It's tough, right? It's really tough. So let's think about what would happen on a large scale if people just said, look, I can't afford my rent anymore, okay? So first of all, let's think about what happens typically with mortgages. All right? You've got all these people out here. These are our homeowners. All right? They've got their homes. Some of these are rented out. And some of these are lived in by the homeowners themselves, okay? Now, as we talked about, I think in class before when we were discussing the financial crisis of 2009, these homeowners typically don't really own the homes. The typical length of a mortgage in the United States is 30 years. So what that means is most homeowners need to pay the bank back for 30 years in order to own the homes. Well, as it turns out, most homes get sold before they reach that 30-year point. And so most homes are in a constant state of really being owned by the banks, okay? So let's see if we can think about Chapter 18, going back to the financial crisis. where did the homeowners get funding for this? Well, chances are they went to a bank, right? And this is like our small bank, let's say. Oh, that's a terrible picture. Let me see if I can do a little better. All right, so this is our small bank. That might be your local bank. You go down to Main Street in your town, and you go to one of those banks where you know the people that are working there, and you get a mortgage, okay? That small bank is going to sell off some of these mortgages, all right? So these mortgages get transitioned off to big banks. Big banks will hold on to some of those, and then they will sell off even more of those mortgages to investors. And hopefully you remember talking about this in class. Those investors might invest in these mortgages through collateralized debt obligations or other types of mortgage-backed securities, right? All right, so if we think about this, if the housing market were to collapse, all of these sectors are going to be harmed. The homeowners might not be able to make their payments anymore. The small banks always own some houses because they have to, they're always holding a few that they're trying to sell off. So even if a small bank is thinking we don't want to be in the mortgage industry, there's always a few that they have on their books, okay? Large banks will hold on to some mortgages. They'll sell some off. That means they always have some as well. And of course, the investors do too. This is all a similar story to what we talked about with the financial crisis a decade ago. But the good news is things are not as bad, okay? These mortgages are still doing okay. The housing market hasn't been affected too much just yet. But what if these people who are renting out houses stop paying their rent? What if these people who have mortgages stop paying their mortgages? Well, the government's already made some ways to basically forgive some of these problems. They're actually slowing the foreclosure process down. So if you stop making payments, you probably won't get foreclosed upon. But here is what's real interesting, okay? This is something we have not talked about in the past. Most mortgages in the U.S. are guaranteed by the U.S. government. These guaranteed U.S. loans come in many different forms. One we've talked about in here is an FHA loan, a Federal Housing Authority loan. Those are guaranteed by the U.S. government. That makes up a percentage of all mortgages. But there are other ways that these mortgages can be guaranteed. Okay? So here's the deal. If the money stops flowing in, the U.S. government is going to be on the hook to pay off trillions of dollars in mortgage payments. So, if rent payments stop and mortgage payments stop as well, the U.S. government will need to borrow trillions to finance the mortgages that the U.S. government has guaranteed. And this just shows you sort of some of the major downside risk when we think about what's going on right now. And that's what I'm real concerned with. I'm not so concerned about with how the economy looks right now, okay? To me, it's the downside risk that scares me. What I mean by that is, it's the worst case scenario. To me, the worst case scenario still seems very bleak, okay? To me, the worst case scenario is a year from now, we still don't have a vaccine. How are these people going to make rent payments, all right? A lot of them won't. Well, then how are these people going to make mortgage payments? A lot of them won't, all right? And you could say, well, maybe the government can keep cutting them checks, but where is that money going to come from? As the government borrows more and more money, it's going to be harder and harder for the government to find borrowers, or lenders rather, right? It's just like me. If I want to borrow money, I can find a loan right now. But the more I borrow, the harder and harder it's going to be for me to borrow. One, because the more I borrow, the riskier I look, right? If I borrow $10, I can pay it back. If I borrow $10 million, it's hard for me to pay back that last buck, right? U.S. government so far has had it no problem borrowing money. Everyone's willing to loan to the U.S. government. But if things get really sustained, if we have this period that we're in right now continues for a long period of time, the government has all these obligations that it already has to pay. And if it has to borrow more and more money, that to me would be a real disaster, okay? So that's where my fear is right now. And you can imagine if this occurs, everything else is hitting the fan too, right? If a year from now the government's having to make these mortgage payments, the stock market's already collapsed as well, and we can think about all the other potential catastrophes that are occurring. That's downside risk. That probably won't happen. The potential upside is maybe we get over this very quickly. There's no way of knowing. But the bottom line is the uncertainty right now is really dramatic, and it's certainly an unusual time to be studying economics. So that's the first video, just thinking about some of the problems that we face. So far, the financial sector is doing just fine. In the second video, we're going to talk about what the U.S. government has done so far to try to improve our economic situation.